Hey everybody, my name is Matthew Sambanis. I'm a certified public accountant. My firm is based in Long Island, New York. And in addition to being an accountant, I've also studied the stock market for close to 20 years, if not 25 years. I've invested in the stock market for that amount of time. And I also study the economy, and we're also going to cover finances and other interesting things of that nature. In today's video, we are going to discuss the current economic crisis of the auto loan industry, the massive repossessions going on, the massive defaults happening, what you can do about it, and how to profit. So 29-year high for default rates on auto loans, huge number. And basically, that's due to two factors, especially in the last 2 to 3 years. A massive amount of inflation, which means the Federal Reserve has printed a ton of money, in particular about 40% of the money at hand has been printed in the last 2 to 3 years. A shortage of automobiles and people having more money than they ever had, meaning not enough supply and too much demand. And, other automobiles on the higher end, their prices kind of stayed stagnant because the government didn't send out $100,000 to everybody or $500,000. Otherwise, if they did, then the prices of Ferraris and Lamborghinis would have gone up, 3, 4, 5-fold. But we're dealing with lower end automobiles. So the price of, a regular Hyundai, which you used to be able to walk into the auto dealer for and negotiate a couple thousand off and get some goodies on the back end, instead went up to having a seller's premium of 10 to 15,000 or some egregious number, whatever, people were willing to pay for. And the end result is, 3 or 4 things. Number one, 17% of new loans that have been created for automobiles are $1,000 or higher. That's an all-time high. That's about 17% versus 4% pre-COVID, right? Huge number, a couple 100% increase. And the average auto loan payment is now $733, which is also at an all-time high. And don't forget, these numbers don't include insurance, repairs, maintenance, gasoline, whatever else you have to spend on your car, fixing it up, put in this new stereo system or, whatever the case may be. So basically, just like everything else, the auto industry has been hit by inflation and the auto manufacturers haven't done anything to help it. If anything, they've done stuff to hurt it because they've profited very handsomely, so much so that the UAW just got a huge increase in their pay. And the CEOs of these huge motor companies, Ford, GM, all their pays went up 25, 35% plus bonus, everything else. They're making 20, 30, $40 million a year, which is absolutely psychotic, to put it nicely, right? So, by the way, these numbers I'm talking about don't include the fact that student loans they're just starting to be repaid. So the contributing factors to all of this were what? People had a lot more money because of COVID. And why do they have a lot more money? Well, the government sent it to them. That's number one. Number two is the government handed it out to businesses, which then handed it out to their workers. That's number two. And number three is they didn't have to pay their student loans. They didn't have to pay their mortgage. They didn't have to pay rent. And I'm sure there's a litany of other expenses that got put on the back burner due to this or that, and now it's crunch time, right? Now you got to pay the piper. So we kicked the can down the road for as far as we could, and to use some real world numbers, in 2022 repossessions were 1.2 million, and now in 2023 they are going to be about 1.5 million, which is a 25% increase. Huge number. I mean, if you think about it, 1.5 million divided by 50 states, that's a lot of repossessions in every state on average. And according to the auto industry in particular, Jeremy Cross, the president of International Recovery Systems, I like that name. What a flashy name. Sounds like a legit company. Based in Pennsylvania. By the way, they're, all they do, that's a glorified name for they repossess automobiles. Said he can't find enough repo men to meet the demand or space to hold all the cars that the company has been tasked with repossessing. So the numbers would be way worse, except there's no employees, or if they do find employees, they're incompetent employees, unfortunately. So the reason I decided to do this video was a few weeks back, and I'm a little late to the game. I noticed the other people had beat me to it. There's an all-time high of people Googling "give car back," right? This is a sad state of America. This is a sad state of affairs. And what that means is people Googling "give car back" is they can't afford their cars anymore. They took on their cars when they had more money than they did, or times have unfortunately beaten them up a little bit, and now they can't afford their car. And they might even be underwater on their car, right? Especially if you went and you bought a Hyundai for 10 to 15,000 over MSRP, and now it's come back down to earth. You have an issue, especially if you lost your job, or if you don't have enough income, or your credit stinks. Then you can't take that underwater difference and roll it into your next lease or into your next car. And unfortunately, you can't give your car back. You can either do one of two things. You could either have it be repossessed, which is still terrible for your credit, or you could turn it in honestly and do a voluntary repossession. No matter what, it's not going to be good for your credit score, and you're going to be without a car. So what would you do to be proactive? Well, unfortunately, there's no right way to do the wrong thing, right? But if I was in that position of having to, turn my car in, then what would I do? I would go get another car first, assuming I had the credit and the earnings to substantiate it for a lot less money, and then I would default and do an honest repossession on my other car. So, get a car for way, way less. Yeah, unfortunately, I'm going to have to take a reduction in my standard of living. I don't get to drive that $1,000 a month Cadillac. I get to drive a couple $100 a month Volkswagen or Hyundai or something, assuming they even have it for those prices. But I have peace of mind, right? And pride is one thing, peace of mind is another. You need to kind of decide which one you want to do. And the other part of that is, obviously economic harm to yourself, depending on how you'd like to look at it. So how did this happen? Well, we know how this happened. I mean, I kind of touched on it before. The Federal Reserve, nobody had to pay for anything, and everybody received a ton of free money for doing nothing. And the supply went way down and the prices went way up. By the way, if you like the economy, finance, anything of that nature, please be sure to like, comment, and subscribe. It means the world to me, and it goes very far. So thank you in advance for doing that. And if you think I've missed anything so far, then please let me know. So $1,000, 17% of new auto loans. And by the way, that's $1,000 monthly payment, usually 67 to 84 months. So that means $67,000 to $84,000 for a new car. What kind of car are you buying, right? The average person in America earns about $40,000 a year. Real wages have fallen, especially since COVID or pre-COVID. How do you justify that? That's $250 a week. That's before you factor in insurance. That's before you factor in your oil changes, brake changes, getting the car fixed up, or having it, getting tints on it, or new rims, or a new stereo system. I'm guilty. I have a very, very nice stereo system in my car. I have two cars, but the one I paid to have it installed with the 12-inch speaker, amp, etc., and the other one, thankfully, comes with the fully loaded voice system. So the difference is when I went and I bought both of them, and they said, "Mr. Sambanis, how would you like to pay for your car?" I said, "Well, I can either pay you with cash, credit, Bitcoin, silver, gold, whatever you'd like. Check, finance it." And, I don't go into debt if I don't have to, unless the interest rates make sense. Then I would consider doing it. If I can get an auto loan for 2.99%, which is what I did, and I can earn 5-6% on a money market, or on 10% on a dividend-paying stock, then I would do that beforehand, right? But at the end of the day, if I don't have the money and I can't write a check, I don't go into debt for something. And the other part is $1,000. There's a lot you can do with that, right? You could, easily max out an IRA for whatever the limits are, $6,000, $7,000 for the year, depending on which year you're in and which year you're maxing it out. You could contribute to a term life insurance policy. You can contribute the money to a 401k. You could do so many better things than go and get some egregious four-wheel depreciating asset that's just going to lose value over time. I don't understand it, and I suggest you not do that. And if you did do it, then figure out what's the solution, right? How do we get out of it? Yes, we made a mistake. How do we make it right? So this is going back to July. This is a recent article from Zero Hedge. Edmunds' second quarter vehicle transaction data shows that 17.1% of consumers who financed a new car signed on for $1,000 monthly payments. Again, that's, that was 13% back then, up from 4.3% when it was COVID. And now like I said, that's closer to 17% now. And the other shocking part of that is, that basically the average APR rate is 8.5 to 9.6%. So call it 9 to 10% interest rate for a car that's costing you $50,000, $60,000, or I guess 70 or 80, depending on which car you're buying and how much money you're putting down. Again, listen, if you need it for work, if you're a contractor and you're going to get some huge Ford F-150 or some GMC Sierra, okay, fine. But at the end of the day, you get the tax write-off, that's great. But if you're going into debt for that interest rate and for that length of time, you have no business buying it. I'm sorry. I'm trying to be direct. And ultimately, this is going to blow up in the bank's faces. It's going to blow up in the consumer's faces. It's going to blow up in the auto industry. It's just going to be a big bubble. This is a huge bubble, and it's going to pop, unfortunately. So going to an article from October 22nd, 2023, the percent of subprime auto borrowers of at least 60 days past due rose to 6.11% in September, the highest in data going back to 1994. So we're close to 30 years that subprime auto borrowers are at the highest in their default rates. So is that the height of the peak? Is that the height of the bubble, or is it going to get worse? It's probably going to get worse. It's probably going to go up 6, 7, 8, 9, 10% before this thing pops in its entirety. And you can go down the block and pick up a car to steal. And you know what? That's the right thing, right? You shouldn't extend credit to people who can't afford it. And it's very easy to tell, I would assume, especially with AI, who falls into that category and who doesn't. And to go a step further and put that in proper perspective, more Americans are falling behind on their car payments than during the financial crisis. So things in terms of car payments due to higher prices and everything else of that nature are worse now than during the financial crisis. I mean, that's, Capital One cut back their auto loans by 50%, and they're going to probably cut it back further. They see the writing on the wall. They're not dumb. And if I were to bet, and if I were a betting man, even though the stock will probably go down, I think it'll eventually go up. If you want to take a short position in it, you could, and you could also go long in it. They're not going anywhere, and they're being proactive instead of reactive. And the other issue is, cars, a used car used to be $7,000 to $15,000. Now they're $20,000 to $25,000. Except what happened? Real wages have gone down. So real wages have gone down. The price of everything's gone up through the roof by 50%, 100%, 200%. And now we have much higher interest rates due to the Federal Reserve. That's a whole other issue unto itself. And yes, they'll probably lower rates preemptively. The problem with that is when they lower their rates, the prices of everything else is going to shoot back up through the roof, right? That's inflation. That's stimulative to the economy, stimulative to money. The prices go up. That's why we're here in this quagmire to begin with, because the Federal Reserve kept rates way too low. It now blew up in everybody's face. So they said, how do we fix this? We fix inflation with higher rates. And if that's the cure to a sickness, then why would you go back into sickness territory and lower rates, right? We're in a catch-22. We have a Federal Reserve, Jerome Powell, chairman, whatever you want to call him, who doesn't know what he's doing. We have a president who doesn't know what planet he's on. And we're in for some rough times, long story short. So, in summation, this is going to get much worse, in my opinion. especially with student loans being starting to be repaid. There's no more moratoriums. Foreclosures are finally starting to happen, at least in New York. They're still dragging their feet, but they're going to pick up their steam again. Other states, they never stopped, which they shouldn't have, in my opinion. And the other issues from here is now the UAW has a sweet deal for all of its employees, even though manufacturing productivity has declined substantially over the last 10 years, right? Those guys are doing less and less work and they're getting more and more money. These car companies are going to go bankrupt again. So how to profit? Well, if it were me, I would watch these car companies that are heavily invested in auto loans and I would short them. And I would also look for these banks that profited and stayed in business during the recession. When their stocks go down, I would buy them, right? You can either go long or you can go short, or you could do both. But at the end of the day, the way the economy is, they say, wow, we have such a great economy. Everything is this and everything is that. The jobs are terrible. They just consist of people having multiple full-time jobs or multiple part-time jobs, and our spending is through the roof, but that's because our credit card debt is through the roof. Personal household debt is also through the roof. Government debt is through the roof. I can't really emphasize this anymore or enough, but we're in for some tough times. And inflation is coming back. It's going to get worse. And unfortunately, the best way for you to protect yourself is to buy gold, buy silver. Silver is at an absolute steal right now, in my opinion. I would have some cash on the side for when the dog hits the fan. If I were looking to buy a car now, I would wait it out for as long as possible. If I was underwater on my car, I would, unfortunately, like I said, there's no right way to do the right thing, but I would look to get another car for way less and just lose that car. And I don't know how that process works, but unfortunately hope for the best and do the next right thing. So hopefully you found this video informative. If you watched it this far, please be sure to like, comment, and subscribe, and hope you have a great rest of the day. Thanks.